Hey guys, this is Jin Choi here from MoneyGeek, and welcome to our first session on how to create a financial plan. But before I begin, I want to explain what I mean by a financial plan. A financial plan answers such questions as, what are my financial goals? What should I invest in? And how much should I save? In our video tutorials, we'll go through more or less the same financial planning process that good financial advisors provide. The only difference is we don't do budgets. That means we're not going to tell you, look, you're spending way too much on lattes, better cut that out to save some dough. The reason why we leave budgeting out is because there's so many good organizations and apps out there for budgeting. You see, budgeting is pretty straightforward. It's easy to calculate how much money you earn and how much you spend, but it's much harder to nail down investing. In fact, the sites that we recommend for budgeting provide not so great advice on investing. But if you're interested in learning more about budgeting, you can check out our resources section. So with that in mind, let's go back to creating our financial plan. The first step is to determine your financial goals. Now, if you're a young professional like myself, and by young professional, I mean someone who's under 40, the answer to this is pretty simple. Retirement is years away, which means we can afford to take a bit of risk. Our goal then is to increase your savings as fast as we can without taking so much risk that it keeps us awake at night. And once we agree that this is our goal, the next step is to figure out what to invest in. To answer this, I'm going to assume that you have a regular MoneyGeek membership. Having a regular membership gives you access to the page that you see in this tutorial. To get to this page, simply sign in and click on the Portfolios menu item. The portfolio page gives you a set of model portfolios that you can follow. So let me first explain what the symbols and numbers are. These symbols represent stocks or ETFs. An ETF is basically like a mutual fund, except it generally charges far lower annual fees, and you can buy them on the stock market. Each ETF would hold hundreds or even thousands of stocks, so you're well diversified by purchasing even just one of them. If you want information about each stock or ETF, you can click on Y like this. The numbers on the right represent the allocation for each stock or ETF. Underneath, you'll also find historical returns and what is called historical standard deviation for each portfolio as a whole. You can think of standard deviation as a measure of risk. The higher the standard deviation, the higher the risk. There's also the Sharpe ratio, which basically measures the historical returns in relation to risk. So the higher the number, the better, but I suggest you ignore this number for now. So you can scroll through the available portfolios that we have. They go from the least risky, which is portfolio 1, to the most risky, and stuff in between. These regular portfolios are constructed with two principles in mind, and they are lower costs and maximum diversification. Whereas the average Canadian mutual fund charges over 2% per year in management fees, the average fees contained in our portfolios are about a tenth of that. Yet they basically invest in the same stuff. And that means your savings on your fees will flow directly to your investment performance so that you achieve higher returns. I've also made use of my PhD to calculate the optimal portfolio mixes. With each of our portfolios from our safest to our riskiest, our algorithm looks at the price histories of each of the stocks and ETFs that make up our portfolios, and it then picks the allocation that would have yielded the same returns but at the lowest risk. This algorithm is not unique to us, it's well known, and advisors that serve the rich use it all the time, and we just applied them to our portfolios. And that's why we call these portfolios optimized portfolios. Please note that portfolios change over time. It changes slightly every day as the algorithm digests new information every single day. But it will also change more significantly every now and then as I change the stocks and ETFs and some of the other underlying assumptions. So how do you choose among these portfolios? Like we said in the beginning, you should choose a portfolio that gives you the highest returns without making you lose sleep overnight for taking too much risk. In finance jargon, this is called measuring your risk tolerance. To measure your own risk tolerance, you can use our risk tool, which you can get by clicking on the How to Choose a Portfolio tab. You'll see that it takes in 3 parameters: the portfolio value, the expected return, and the expected standard deviation. And for your convenience, we filled out these last 2 numbers in for you. You'll see that these numbers correspond to portfolio 3's number. And if you changed it to another portfolio, you'll see that these numbers also change. So to get started, really all you need to put in is the portfolio value. Now, unless you have a strong view about the future, I think using historical values are a good idea. If you do feel strongly about the future, say you're a bit more pessimistic about it, then you can choose to do stuff like lower your expected return. And you can play around with the risk measures as well. But for now, let's assume that the future will look like the past. So let's revert this back to our historical value. And let's say we have a hypothetical $10,000 in savings that we want to invest. And let's click on Analyze. So let me explain these numbers to you. So the good case means that if you're lucky, in the next year, your investments will increase by $1,700. And over the next 3 years, if you're just as lucky, your investment will grow by over $4,000. On the graph, if you scroll underneath, you will see this green line, which represents the good case. On the average, though, your savings will increase by around $700 next year. And this is the yellow line on the graph. And this is all good, but the numbers that you should really pay attention to are the bad and worst case scenarios, because these are the cases that represent when the crap hits the fan and you start losing sleep over your investments. So in the bad case, you might lose $300 with portfolio 4, and in the worst case, you might lose $1,000. And so for the bad case, this might happen maybe once in 10 years, and the worst case might happen a couple times in your life. So what you should do when you look at these numbers is you should imagine yourself losing these amounts, and you should ask yourself, would I feel okay, or would I panic and sell everything? You see, in 2008, the world experienced one such worst case scenario. The US stock market lost over 30% that year, and that was the worst year since 1931. Many people panicked and sold all the stock that they held. And had they held on, their stocks would have gained 26% in 2009 and 15% in 2010. And by 2013, they would have regained everything they lost. But many people who panicked missed out completely on the rebound. My point is, panicking can cost you a lot of money. So make sure you choose a portfolio where you feel that you can handle even the worst case scenario. But let's say that in your case, you think you can tolerate a bit more risk than losing, say, $1,000 next year. In that case, let's change our portfolio. Now let's click on Analyze again with this higher risk portfolio, and you'll see that the numbers have changed. You'll see that the potential losses from bad and worst case scenarios are bigger. And so you ask yourself again whether you can tolerate these kinds of losses. And if you can't, then you can always go back to the lower risk portfolios. So this is how you choose a portfolio. Remember, choose the one that gives you the highest return with a risk profile that you can tolerate. After you've chosen your portfolio, it's time to put it into action. For that, you go to the How to Put the Portfolio in Action tab. And once you're there, simply put the value of your portfolio into this field. So here you see that in order to put portfolio 5 into action, you should buy 39 shares of XSP.to, and based on yesterday's price of $28.85 a share, the value of your XSP.to is $1,125. And of course, you should buy every stock and ETF listed on this page. You can buy shares using something called a brokerage account. All the banks offer brokerage accounts. If you have one of these, you can just phone your broker and say, I want to buy 76 shares of CWI, for instance. However, bank brokerages do cost a lot of money, often more than $20 a trade. So if you want to save money, I highly recommend going with a discount brokerage like Questrade. And we have a video tutorial on how to open and use a Questrade account on our site. And in terms of using tax vehicles like the tax-free savings account or RRSPs, I personally recommend the following for young professionals. First, max out your TFSAs. Then, if you're thinking about buying a house in the next few years, contribute up to $20,000 into RRSPs. If not, or if you hit $20,000 in RRSPs already, put the rest into a margin account, which is a normally taxed account. Questrade offers all these types of accounts. And please know that this advice only applies to young professional. If you're closer to retirement, the tax vehicle situation gets a little bit more complicated. So to recap, in this section, we've looked at how to invest your savings you already have. In the next session, we'll look at planning for your retirement. And until then, happy investing.